Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 1. Chapter 1 covers understanding and working with the federal tax law. So we'll jump right into this first question. Here it states, regarding items for purposes of substantial authority, select either primary source or secondary source for each of the following. So, as it relates to tax law, in general, tax authority, it can be classified either as what's called primary or secondary. So, primary authority that comes from statutory, administrative, and judicial sources, and secondary authority, on the other hand, consists of any unofficial sources or tax information. This could be tax services, it can be journals, textbooks, newsletters. So, as a tax practitioner, it's very important to know whether or not where you are referring to, if it's a primary source or if it's a secondary source, especially when you are dealing with tax law. So here we see it starts off with revenue procedure. So revenue procedures, this is considered a primary source. So as mentioned, primary sources of tax law, it includes the Constitution, legislative history materials, any statutes, any treaties, treasury regulations, any IRS pronouncements, lastly, any judicial decisions. So the IRS, the Internal Revenue Service, they regard only primary sources as substantial authority. So just keep that in mind. However, they do reference these, secondary materials such as any legal periodicals, treaties, legal opinions, etc. But secondary sources are not considered authority. So that's why, as mentioned earlier, as a tax practitioner, it's very important to differentiate between a primary source and a secondary source. So revenue procedures are considered a primary source. If there's an article written by a judge in the Journal of Taxation, based on what we just discussed, this would be considered a secondary source. U.S. District Court decision, this would be considered a primary source. So any decision that's rendered by a trial court, it carries less weight than one that's issued by an appellate court. So under the code currently, any decisions by the U.S. Supreme Court, that represents the last word on any tax issue ultimately. The Blue Book, this would be considered a secondary source. It does have substantial authority, when it comes to certain portions of the tax law, but for the most part, the Blue Book, which is essentially like a detailed overview of certain tax laws, but the Blue Book is still considered a secondary source. Lastly, we have a General Counsel memorandum. So this is also considered a secondary source, although it does have substantial authority for purposes specifically related to accuracy related penalties. All right, so again, very important thing to keep in mind. What is a primary source? What is a secondary source? So this brings us to our next question. And here it asks, what is meant by revenue neutrality? So it says select the correct answer to the question, what is meant by revenue neutrality? So as it relates to revenue neutrality, we'll go through the questions first. It's asking, revenue neutrality means that any changes resulting from new tax legislation neither increase nor decrease the net revenues raised under the prior law. B, revenue neutrality means that any changes resulting from new tax legislation must reduce tax deficits. And C, revenue neutrality means that any one taxpayer's tax ability to remain the same as a result of new tax legislation. So the federal tax law is essentially a mixture of statutory provisions, administrative pronouncements, as well as court decisions. But the main purpose of the tax law is to raise revenue, right? So if we even think of tax law at its inception, originally income tax was instated when the government needed to fund the Civil War. So, they came up with this idea, this is a way to raise revenue. And even though, tax law was repealed and it was reinstated and made constitutional by the 16th Amendment, From its inception, the main reason for imposing taxes was to raise revenue. So here we have this what's called revenue neutrality. So one of the key things is whenever they enact tax legislation, Congress, they're guided by this concept of revenue neutrality. And what this simply means is that any changes neither increase nor decreases the net revenues raised under the prior rules. Revenue neutrality, it doesn't necessarily mean that a taxpayer's liability remains the same, because again, if someone makes more money, then obviously their tax liability will increase. Vice versa, if they make less money, their tax liability would ultimately decrease depending on the situation. But since this liability depends on the circumstances involved, a taxpayer's increased liability, it could be a form of a tax savings. And here it says revenue neutrality means that any changes resulting from new legislation must reduce tax deficits. That's not necessarily the answer. It can help to aggravate rather, or to solve the problem, but it doesn't necessarily mean that that will happen. So the correct answer is A. Revenue neutrality means that any changes resulting from new tax legislation neither increases nor decreases the net revenues raised under the prior law. All right, this brings us to the next question. So it's asking, complete the following statements to answer the question, how might the IRS restructure this transaction with adverse tax consequences? So here we see White Corporation lends $425,000 to Blue Corporation with no provision for interest. White Corporation and Blue Corporation are owned by the same shareholders. Complete the following statements to answer the question, how might the IRS restructure this transaction with adverse tax consequences? So, the IRS has secured from Congress legislation of a more general nature that enables it to make adjustments based upon the substance rather than the formal construction of what a taxpayer has done. So simply stated, here we see that it's referring to section 482. So we'll actually look at it. Section 482. And here we see under Internal Revenue Code, section 482, which deals with allocation of income and deduction among taxpayers. So here it states, in any case of two or more organizations, trades, or businesses, whether or not incorporated, whether or not organized in the U.S., or whether or not affiliated, owned or controlled directly or indirectly by the same interest, the secretary may distribute, apportion, or allocate gross income, deductions, credits, or allowances between or among such organizations, trades, or businesses if he determines that such distribution, apportionment, or allocation is necessary in order to prevent evasion of taxes or clearly reflect the income of any such organizations, trades, or businesses. So simply stated, what this means is that under section 482, the IRS basically has the authority to restructure the way in which a tax transaction has took place if the sole purpose of that transaction was to evade taxes. So here we see in this example, right, they lend $425,000, but there's no provision for interest. So think about it, right? If you go to a bank, sometimes if you borrow money from family, they won't charge you interest, but for the most part, it's very hard to get an amount of money, especially a large amount of money like this, and there's no interest, right? So in this case, the IRS has the authority to allocate. Is it only income? Is it only deductions? But based on what we just saw here, they have the ability to allocate both income and deductions among businesses owned or controlled by the same interests when the allocation is necessary to prevent. What do we want to prevent? Avoidance or evasion. So it's very important to realize that avoidance is legal. Tax avoidance is legal. That's essentially when you simply use the tax law to avoid paying taxes. Evasion, on the other hand, that's illegal. That's where you are doing things that are not in alignment with the tax law, so that way you pay less taxes. So to prevent the evasion, and as we see here, the verbiage is clearly stated here, in order to prevent evasion of taxes, to clearly reflect the income of each business. And as a result, the IRS might allocate, are they going to allocate interest expense, or are they going to allocate interest income? In this case, they would have to recognize interest income. They would allocate interest income to white corporation, even though none was provided for in the loan agreement, right? So these are one of the things that make you very valuable within the tax profession. It's great to know how to prepare taxes, but white corporation, blue corporation, more than likely, especially with largeness, lending this large amount of money, they would have went to their tax professional, their enrolled agent, their certified public accountant, their tax accountant, to ask them, hey, if we move forward with this transaction, what are the potential tax implications? Tax consulting is a very great market because, again, especially with the advancement of technology, somebody can just, put all of their information in using AI to create their return. But it's things like this that you still need the human touch. You need the human understanding to break down the nuances of something like this, Section 482, to let them know, hey, this is the possibility of what might happen. All right. So this brings us to our next question. Where does most tax research begin when someone is searching for an answer about a tax dispute? So here we see, complete the statement below in response to the question, where does most tax research begin? So tax law consists of a body of legislative, administrative, and judicial pronouncements, as we mentioned earlier. So working with the tax law, it's very important to be able to know how to not only locate, but you need to know how to effectively utilize these sources, right? Because again, it's important to determine, is this a primary source or is this a secondary source? Primary sources, we know, have substantial authority, and secondary sources, they do not. So some tax researchers, they begin using a keyword search on an online tax service. Some people, they, might just use Google, like you see here. I just use Google, but for the most part, it's taking me to a reputable site, Cornell Law School, where they they have a breakdown of the tax law. Section 26, which is the Internal Revenue Code, and then a specific section, which is 482. However, there are specific tax databases within the profession that is used in order to do tax research. So as you become more well-versed, for those of you who do want to become a tax practitioner, Google helps as a starting point. But again, some information on Google is not always accurate. So you definitely want to make sure that you find the most relevant information. And then also you want to become more familiarized with some of the online tax services and the tax research databases that are available. All right. So in the event that, let's just say, the problem's not complex, it's something, very simple, the researcher, they might not need to use a tax service. Maybe they can go directly to the Internal Revenue Code. Maybe they can use Treasury regulations and things of that nature. So for someone who's starting out, this will save you a lot of time and help to solve a lot of basic issues. So let's say a client comes and maybe they their niece lived with them, or their a taxpayer, their grandchild lived with them, and they want to know, hey, can I claim this child as a dependent? They'll give you the basics, the facts, and then okay, we'll see in IRC dependents. We go to Internal Revenue Code. So here we have IRS Publication 501. This basically provides us with everything we need to know regarding dependents, right? So we can do a search. We find dependents. And then we just, scroll through to see, okay, where does it start telling us about dependence? So here we see, okay, all right, this is leading us somewhere. Dependence explains the difference between a qualifying child and a qualifying relative. Okay, so let's go look at the basics for a qualifying child. All right, let's just say that it's the grandchild. So relationship. To meet this test, your child must be son, daughter, stepchild, foster child, or descendant. Example, your grandchild. Okay, based on this, the grandchild might be a dependent. So again, at the very basic level, that's something that you can do. But for complex tax matters, you definitely want to be able to use the tax service. So that's just something to keep in mind. If the researcher doesn't have any access to the code or the regulations, then they're gonna need to use a tax service. All right. So some tax researchers, they begin with a keyword search on an online tax service. Again, federal tax articles, revenue procedures, secondary sources, and if the problem is not complex, the researcher may turn directly to the Internal Revenue Code. All right, so here it says interpret each of the following citations. All right, so we'll start to look these up. So temporary regulation section 1.707. So we'll search that. All right, and we'll search it from Cornell. So here it says disguised sales of property to partnership, special rules relating to liabilities. All right, so here it's asking us, how do we essentially, determine, well, what does this even mean? We see temp reg, we see, these double S's, we see 0.1707, we see -5T. So we might be wondering, wait, what does this even mean? So we're gonna go through the basics of, how we determine what this actually means. So the one, as we see here in 1.707, the one refers to the type of regulation. So this is a temporary regulation. Next is asking the 707. The 707 refers to the code section. The 5 refers to the subsection, and the T refers to the temporary, right? Because again, it lets us know here temp regulation. So it lets us know that it's temporary, whereas the A, as we see here, refers to the specific paragraph, and the 2 refers to the sub paragraph, right? So this is it makes it much easier, because think about it like with accounting, right? You have everything organized and structured. So if somebody is referring to this, they can tell right off the bat, hey, this is the type of regulation, it's temporary. This is the code section. Because imagine if somebody just tells you the type of regulation, but they don't tell you the code section. It would be, if this is 707, imagine if there's 1,000 code sections, right? But knowing that you need to go to regulation 1, the type of regulation, which is 1, and you go to code section 707, that saves you time versus trying to go through all 1,000. Here also makes it much easier. You know that you need to go to subsection 5, and you know that you need to go to paragraph 8. Imagine if there's 20 paragraphs, right? So this is just an easy way. Again, this is when you venture more into tax research, knowing not only where to find the information, but how to decipher that information. Next, for B, here we see revenue ruling 60-11 1960-1 CB 174. So here, revenue rulings, they're official pronouncements of the National Office of the IRS. They typically provide one or more examples of how the IRS would essentially apply a law to specific fact situations, because based on the situation, things might or might not change, right? So revenue rulings and revenue procedures, they're published weekly by the US government in what's called the IRB, and that stands for the Internal Revenue Bulletin. All right, and then they essentially incorporate all of the weekly rulings and the procedures, and they publish them twice a year, semi-annually, in the cumulative bulletin. So the 11 here refers to the revenue ruling number. 174 refers to the page number. The 1, as we see here, refers to the volume number. And of the cumulative bulletin, the 1960 refers to the year that it was issued. All right. So again, once you venture more into tax research, a lot of this will make sense. And lastly, we have here this TAM 8837003. So TAM stands for Technical Advice Memorandum, right? So TAMs resemble letter rulings in that they essentially give the IRS's determination of an issue. And TAMs, they're issued with multi-digit file numbers. So the 3 here refers to the Technical Advice Memorandum number. The 37 refers to the week that it was issued, and the 88 refers to the year that it was issued. All right. So again, this is just some, great information to know, depending on the type of, tax profession you'll get into. Sometimes it might just be, again, preparing returns or reviewing returns. But if you want to dive a bit deeper into the practice of taxation, you definitely want to be able to get a better understanding of how citations work and how we can interpret them. All right, this brings us to our next question. Here it asks us, comment on the validity of this statement by completing the sentence below. It says federal tax legislation generally originates in the Senate Finance Committee. Comment on the validity of this statement by completing the sentence below. Federal tax legislation generally originates in the blank, where it is first considered by the blank. So the Constitution grants Congress the power to impose and collect taxes. So understanding taxation requires that you understand the sources of these tax laws. So whenever there's statutory sources of tax law, that includes the Constitution, tax treaties, in addition to the Internal Revenue Code. So federal tax legislation, before it can even become a part of tax law, because unfortunately there's this misconception that the president makes the laws, and that's not necessarily true, right? So federal tax legislation, it generally originates in the House of Representatives. And that's where it's first considered by the House and Ways and Means Committee. So tax bills, they originate in the Senate when they're attached as riders to maybe other legislative proposals that are brought up at the time. If it's accepted by the House Ways and Means Committee, then that proposed bill is referred to the entire House of Representatives, and they can either approve it or they can decide to disapprove it. If they do approve it, then it goes to the Senate, and then it's referred to the Senate Finance Committee for further consideration. Again, they can either agree or they can disagree. So in the next step, let's just assume that the Senate Finance Committee, they like the idea, they move forward. It's referred from the Senate Finance Committee to the whole Senate. And assuming, let's say, maybe there's no disagreements between the House and the Senate, then the bill is passed and then it goes to the president. And now it's either the president approves it or the president vetoes it, where it can be, overridden. So again, there's a really big process before tax law even becomes tax law. So it's very important to keep in mind. So federal tax legislation, generally, it originates in the House of Representatives, where it is first considered by the House Ways and Means Committee, and then it works its way up from there. It goes to the Senate, goes to the Senate Finance Committee, then it goes to the whole Senate, and then if it's passed as a bill by the Senate, it goes to the president, and then if approved by the president or it is vetoed by 2/3 of law, it becomes a part of the Internal Revenue Code. So this brings us to our next question. Here it says, select either yes or no for each of the following to indicate whether it is a key component of effective tax planning. So to avoid the recognition of income. So as mentioned earlier, tax avoidance is legal. Tax evasion, however, is illegal. So tax research and tax planning is basically inseparable. The main purpose to effectively tax plan is, No one wants to pay Uncle Sam any more than they need to. So here we have avoiding the recognition of income. So to avoid the recognition of income, yes, it is a component of effective tax planning. Why? You essentially assess the tax law and see if there's anything that the client can do in order to avoid recognizing the income. Deferring the recognition of income, yes, or you basically want to accelerate deduction. So like they have something that's called Section 179. With Section 179, you can essentially write off more of the expense in the beginning versus having to allocate it over a number of years. Here we have converting the classification of income. Yes, right? This is definitely important when, let's say, you have ordinary income versus a capital gain, or if you have an ordinary loss versus a capital loss, they are treated differently depending on the classification of the income or the classification of the deduction. Choosing the business entity with the desired tax attributes. Yes, this is definitely a part of key tax planning. The reason being is because now there's like a really big push for individuals to create S corporations, right? There's this big nuance that they can essentially save on self-employment taxes. And yes, it's definitely true, obviously, if it is done correctly, or depending on a client situation, they might be a very high income earner. They might be in a 37% tax bracket where it makes more sense for them to have a C corporation, and the C corporation pays a flat 21%. So this is where effective tax planning comes into place. So lastly, we have deferring the recognition of expenses. So deferring the recognition of expenses, that will essentially increase individual's tax liability. So ultimately it depends. There's times where clients, they want to show more income. Let's say the client is looking to purchase a home or something of that nature, where their financial statements are being reviewed to see if they have enough money. That is where deferring the recognition of expenses so they have a higher income might come into play. But for the most part, tax planning, one of the effective things is that you want to ultimately reduce your tax liability. So that is why E is no. Avoiding the recognition of income, deferring recognition of income, converting the classification of income, and choosing an entity with a desired tax attribute. All of these effectively can be utilized to reduce one's tax bill, whereas deferring recognition of expenses will increase an individual's tax bill because they are reporting more income. All right, this brings us to our next question. Here it asks, for each of the following, select either true or false concerning the continuity of interest concept. So this interest concept is primarily concerned with business readjustments. So the continuity of interest concept, it permits tax-free treatment only if the taxpayer retains a substantial interest in the property that was transferred to the new business. So due to this continuing interest that's retained, the transfer, they shouldn't have a tax consequence, right? Because if you think about it, in reality, the position of the taxpayer, it didn't really change, right? So based on this, we're going to answer these questions. It says applies to control corporations and corporate reorganizations. This is true. It permits tax-free treatment, which is true, because again, I'll make it a little more easier to understand. Let's say I decided to start a corporation. I'm a homeowner, and if I decided that I transfer my home into my corporation, which I own 100%, I still have ownership. It's just that now the home is, in the name of the corporation, but I still have substantial, interest, substantial authority in the corporation. Hence, why would I have to, let's say, recognize taxable income on the appreciation of the property? I still have ownership, right? So that's essentially on a small scale what this question is asking. So here it's asking, with the continuity of interest concept, should it result in tax consequences because the position of the taxpayer has changed? is false. Again, as I just mentioned, I own a home, but then I start a corporation and I put my home in the name of the corporation. I still 100% run the corporation. So the position has not changed. Lastly, it applies to continuing interest in property that's transferred to a new business. This is true. This brings us to our next question. It asks, using the legend provided, classify the overall objective of the particular tax provision. So A, if there's a like-kind exchange treatments, but we'll look at the legend first. CE is control of the economy. EA, encouragement of certain activities. EI, encouragement of certain industries. SC, social considerations. W, wherewithal to pay. AF, administrative feasibility. ESB, encouragement of small business. All right, so first, we see what's called this like-kind exchange. So with a like-kind exchange, this is essentially where, let's say I own a property, a building, and I want to sell it, and I purchase, another building. I use the proceeds from the sale of the first building to purchase another building. That's similar to, or that is essentially the concept for a like-kind exchange treatment. So the foundation of any tax system, it has to be to raise money, as we know, to absorb the cost of government operation. So, but at the same time, we also want to use the tax system to accomplish some economic objectives. Right. So what this simply means is that Congress, the Internal Revenue Code, they work together. They want to ensure that they encourage certain individual activities and they encourage certain business activities. And some of these laws, they're, related to the federal income tax of individuals and with social considerations. So some key things to keep in mind. So with this like-kind exchange treatment, again, I purchased the building. Now I want to sell it and purchase another building. This concept will be governed by the wherewithal to pay. So the wherewithal to pay concept, that essentially recognizes the inequity of taxing a transaction when the taxpayer doesn't have the means to pay it, right? So think about it like this. As mentioned, I'm a homeowner, and let's say I purchased my home for $100,000 and now it's worth $200,000. Imagine if, based on tax law, I will be taxed every time my property appreciates in value. That doesn't make any sense. I don't have, the money to pay taxes on $100,000 that appreciated in value. So that's essentially what the wherewithal to pay concept. It's inequity. It doesn't make sense, for lack of a better word, to tax a transaction when the taxpayer does not have the means to pay the tax. If I sold the home and I receive the difference, the $100,000, or let's say, I bought it for 100,000, I sold it for 100,000, the current value, then okay, I received the $100,000, I'll be able to pay the tax. But just because there was an increase in value does not mean that I have the money to pay the increase in tax. So something to keep in mind. Next, we have an increase in the individual tax rate. So with an increase in the individual tax rate, this impacts the control of the economy. So whenever there's a change in a tax rate structure, it has a more immediate impact on the economy. Why? Because when we file our taxes as individuals, we feel the brunt effect of that. Whenever the tax rates are lower, taxpayers, they're able to attain, additional funds that they can disperse, personal, whatever it is they need to do, right? But again, an increase in the individual tax rate, this has an impact with the control of the economy. Next, we have the S corporation election. This impacts the ESB, which is the encouragement of small businesses. So in the corporate tax arena, there's several provisions that can be explained because they want to have the benefit of a small business. So the S corporation election is one of those examples. So with the S corporation election, this essentially is like a hybrid between a corporation and a partnership. It's a pass-through entity. And one of the benefits is that the shareholders, they have the ability to strategically set up their business whereby they can avoid self-employment taxes. Well, not necessarily avoid, but help to well, I mean, when you think about it, that's why a lot of people do set it up. But there's obviously more nuance with an S election because compared to just having a regular partnership or a sole proprietorship, you now need to file a separate form. There's more limitations as far as the percentages of income that can be shared if there's more than one shareholder. So there is a bit of nuance, but for the most part, for businesses that make a certain amount of money, you can look at the tax savings and it does make sense. So something to keep in mind. Next we have adoption expense credit. So with the adoption expense credit, this is a social consideration, right? So this is essentially to encourage persons to adopt. So rather than using loans or grants and other programs, Congress sometimes they use the tax code to provide incentives and benefits. So with the adoption tax credit, it's up to $13,570 and it covers expenses incurred by individuals who adopt or attempt to adopt a child. Next, we have percentage depletion, and this is an encouragement of certain industries. So this is EI. And the tax law basically favors the development of natural resources by permitting the use of what's called percentage depletion. So anytime they have to extract the sale of oil and gas and any specified mineral deposits, they can write it off versus capitalizing it. So what that simply means is that they can write off the full cost versus having to capitalize or depreciate it over a number of years, right? So that is an encouragement of certain industries. Next, we have the annual gift tax exclusion. So this is administrative feasibility, AF. So what this simply means is this provision decreases the number of tax returns that must be filed, as well as it reduces the taxes paid and, pretty much saves an audit effort. So annual gift exclusion basically means that persons are allowed to gift up to a certain amount each year without needing to file a tax return. If the individual gives more, then they need to file Form 709. The person that's receiving the gift, they don't need to do anything. It is the person that is giving the gift that potentially needs to file Form 709. Lastly, we have charitable contribution deduction. This is also an example of a social consideration because individuals are, assuming they take itemized deductions, they are able to write off the amounts that they donate to 501c3 or other recognized charitable organizations and receive a tax benefit. So that's definitely a social consideration. All right. Next, we're going back to primary sources versus secondary sources, both or neither. So here we see the 16th Amendment to the U.S. Constitution. This is primary. Next, we have a tax treaty between the United States and China. This would be considered primary. Next, we have our temporary regulations. These would also be considered primary. Our revenue procedure would be considered primary. And just to make sure, you guys remember, primary sources of tax law includes the Constitution, legislative history materials, statutes, treaties, treasury regulations, IRS pronouncements, judicial decisions. The IRS regards only the primary sources of substantial authority. However, reference to secondary materials. This includes any technical advice memorandums, TAMs, any written determinations, any legal opinions, any legal periodicals, etc. These are considered helpful, but secondary sources are not authority. And just keep in mind that although the IRS only regards primary sources as substantial authority, there's an exception. Sometimes, for purposes of what's called the accuracy related penalty in section 6662, the IRS expanded a list of substantial authority, and this includes some secondary materials such as letter rulings, the blue book, technical advice memorandum, etc. So that's something to keep in mind. So next we see IRS publication. This would be considered secondary. A tax court memorandum decision. This would be considered primary. A Harvard Law Review article would be considered secondary. Legislative regulations would be considered primary. As we pointed out, letter rulings as it relates to section 6682, it's a substantial authority, even though it's a secondary source. So letter rulings would be considered both. The Fifth Circuit Court of Appeals decision would be considered primary. A small cases division of the U.S. Tax Court decision would be considered secondary. Senate Finance Committee report would be considered primary. A technical advice memorandum, 1993, would be considered secondary. Proposed regulations would be considered secondary. And a notice would be considered primary. All right. So again, once a tax practitioner locates a source, it's definitely important to determine whether or not the source is primary or if the source is secondary. And the reason why this is important is because you need to assess it correctly to ensure that it is being interpreted correctly and consider the law's relevance as well as its validity based on the case at hand. All right, so here for this problem, it's asking, using the legend provided, classify each of the following citations as to the location. A citation may have more than one answer. So for A, we see section 61. So essentially, whenever we're dealing with the Internal Revenue Code, there's specific symbols that we can see that essentially lets us know that it's referring to the Internal Revenue Code. So whenever we see these double S's, that lets us know that it is the Internal Revenue Code. Here for B, we see Prop Reg. We see the double S 1.368. So we have what's called proposed, final, and temporary regulations, and these are published in what's called the Federal Register. Final regulations, they're also found in the Internal Revenue Bulletin as well as the Cumulative Bulletin. So the correct answer would be FR, IRB, and CB. All right. Next, we have Revenue Procedure 77-37, 1977-2, CB 568. So the proper form for citing rulings and procedures, it ultimately depends on whether the item has been published in the Cumulative Bulletin or if it's available in the Internal Revenue Bulletin. So this revenue procedure can be found in either the IRB or the CB, again, depending on whether or not it was published in the Cumulative Bulletin or the Internal Revenue Bulletin. Next, we have Temporary Regulations 1.163, 9T, B2IA. So, as mentioned earlier, the proposed final and temporary regulations, they're published either in the Federal Register, FR, the IRB, which is the Internal Revenue Bulletin, or the Cumulative Bulletin. So for D, the answer would be the same as B. For E, we have Revenue Ruling 64-56, 1964-1, CB 133. So the proper form of citing any ruling and procedures, again, it depends on whether the item was published in the Cumulative Bulletin or if it's available in the Internal Revenue Bulletin. So the answer for E is the same as C. Next, we have Jack E. Golson, 54 TC, 742, 1970. This is a tax court decision. This will not be cited, so it'll be NA. The same thing for the letter ruling, 980, 2018. This is a letter ruling, so not applicable. Just one key thing to keep in mind. So a citation or a cite, it's a reference to a specific legal or tax source. And this could be a regulation, it could be a statute, it could be a constitution. So this is basically like a shorthanded, like an easier method of identifying an authority. So one basic format of a citation, it includes the volume number, the title of the publication, what the page is, the section number, the date. So the citation for a regulation, it basically contains three organization units. What's the part number? What's the code section number? And what's the regulation section number? So just something to keep in mind. And again, for those of you who want to venture into taxation and you essentially want to, just get a better understanding of how taxation works, then in such case, it's best not just to focus on tax preparation and tax review, but also just understanding the basics and the nuances of tax law. All right. So here we see it's asking us, Benny is the shareholder of Jet Corporation. The IRS may question the blank. The IRS may determine that blank. And the IRS probably blank, right? So here we see Benny. And it states Benny sells property with a basis of $70,000 to Jet Corporation for $100,000. Based on the following conditions, how could the IRS challenge this transaction? So the basis is 70,000, sold it for 100,000. He's the sole shareholder of the corporation. The IRS, they might want to question the sales price, right? They might consider, hey, well, what if he sold it to another corporation? Or what if it was an arm's length transaction? He just sold it on the market. It's probably worth a lot more. So the IRS might want to determine whether or not he's intentionally trying to evade paying capital gains. Benny's the son of the shareholder of Jet Corporation. The IRS may determine that it was actually constructive dividend that was warranted to Benny's father for the difference between the sales price and the fair market value of the property. So again, this is why it is so beneficial as a tax practitioner to also understand the nuances, because now you can consult. Benny, can come and ask you these questions. Hey, what would happen if I sell it for 100,000? What would happen if I only sold it for 70,000? Right? So these are the things that clients want to know. And lastly, for C, it says Benny is neither a shareholder in Jet Corporation nor related to any of Jet's shareholders. In such case, the IRS, they wouldn't have a reason to question the substance of the sale. It, appears to be a true sale that takes place. All right. So this brings us to the end of the questions for chapter 1. Again, one of the key things with chapter 1 was just understanding and working with the federal tax law. We covered a lot. We essentially identified some tax law sources, statutory, administrative, judicial, conducting tax research and what are the basics of doing such, what are some tax planning procedures and things of that nature, demonstrating what's the influence of economic, social, equity, and political considerations as it relates to the development of tax law. So again, there's a lot to learn in taxation. This is just the fundamental. And one thing that I always say is you will never fully understand a tax law. It is so vast, but it is a great quest to want to continue to learn.